Small Wins, Big Wealth. The Power of Consistent Investing. Written by Ronnie Rowland. Published by Growth Literacy Lounge. What if the secret to building lasting wealth isn't a big risk or a stroke of genius, but the small, steady actions you take every single day? In the late 1980s, a young teacher named Sarah stood in line at her bank. Her paycheck barely covered her rent, groceries, and a modest car payment. She felt trapped in a cycle of financial survival, a far cry from the secure future she had dreamed of. Then, a conversation with a kindly older banker changed everything. He asked her, "Do you know about the rule of compound interest?" Sarah shook her head. He explained small, consistent investments grow like a snowball rolling down a hill. Over time, they turn into something astonishing. Intrigued but skeptical, Sarah decided to test his advice. She started with $50 a month, an amount so small it almost felt pointless. But she stuck with it, month after month, year after year. Fast forward 30 years, and Sarah is no longer that young teacher. She's a retired educator who travels the world, volunteers with causes she loves, and has built a nest egg worth over $1 million. All because she embraced the power of small wins and consistent investing. This is not a story about luck or extraordinary circumstances, it's a story about you. It's about how small, consistent steps can lead to life-changing results. And it's about how financial freedom is not reserved for the wealthy or the brilliant, but for anyone willing to commit to the process. So ask yourself, could the secret to building wealth be simpler than you've ever imagined? In this book, you'll learn the proven strategies and habits that have transformed ordinary lives into extraordinary ones. We'll uncover the psychological traps that hold most people back from financial growth, the specific steps to start investing today, even with minimal resources, and how to stay consistent in the face of setbacks. But most importantly, we'll answer the question: how can you transform small, daily actions into the wealth and freedom you dream about? By the end of this book, you'll have not just the knowledge, but the confidence and roadmap to build your own version of Sarah's story. Are you ready to begin? Chapter 1. The Myth of Overnight Success. Why do we believe in big wins over small steps? Why are we so drawn to the idea of overnight success, even when deep down, we know it's a myth? When Josh first saw the dot-com boom sweep across the headlines, stories of people turning thousands into millions filled the airwaves. One day his neighbor Dan quit his job, claiming he'd struck gold with an online startup. By the end of the year, Dan was driving a new car, vacationing in Europe, and throwing lavish parties. Josh was captivated. A few years later, Dan's luck ran out. The startup went bankrupt, and the car was repossessed. Meanwhile, Josh had been slowly but steadily contributing to his retirement account, investing in index funds, and living within his means. Today, Dan is rebuilding from scratch, while Josh is nearing financial independence. What separates these two stories? The difference lies in the way each man approached the journey to wealth. Dan chased the allure of a big win. Josh understood the quiet power of small, consistent steps. The myth of overnight success persists because it's exciting. Big wins capture our imagination. Think of lottery winners or tech geniuses who disrupt industries. These stories dominate media because they sell dreams, not reality. But beneath the surface lies the truth. Most millionaires didn't get rich overnight. They built their wealth gradually, brick by brick. According to studies, the majority of millionaires are self-made, and their secret isn't glamorous. It's consistency. Let's shift the narrative. Imagine planting a seed. You water it daily, and for weeks you see no change. But underground, roots are growing. When the sprout finally emerges, the transformation seems sudden, but the progress was happening all along. Wealth works the same way. Every dollar invested, every expense cut, and every financial habit reinforced is like watering that seed. Over time, the results compound into something extraordinary. Consider Warren Buffett, one of the wealthiest individuals in history. Most of his wealth didn't come from early, risky moves. It came from decades of consistent investing and letting compounding do its work. He famously said, "I always knew I was going to be rich. I don't think I ever doubted it for a minute." But his confidence wasn't in luck, it was in the power of time and consistency. If small wins are so powerful, why don't more people embrace them? 1. Impatience. People want results now. Waiting years for compounding to show its effects feels counterintuitive. 2. Fear of being too small. Starting small feels insignificant. Many think, what's the point of saving $10 or investing $50? 3. Comparison. Social media amplifies success stories, making slow progress seem inadequate. These barriers are mental, not physical. To overcome them, we must change how we perceive progress. The first step to building wealth isn't finding the perfect investment or saving a massive amount. It's starting. Whether it's $5, $50, or $500, the key is consistency. Over time, even the smallest contributions add up in ways that are almost magical. For instance, if you invest just $100 a month with a 7% annual return, you'll have over $120,000 in 30 years. Imagine what happens when you increase that amount as your income grows. So why are we so drawn to the myth of overnight success? Because it's a shortcut, an escape from effort and time. But the truth is, lasting wealth isn't built in leaps, it's crafted in steps. The most powerful way to build wealth is through small wins, repeated over and over. As we move forward in this book, remember this: you don't need a big break to achieve financial freedom. You just need a plan, patience, and the courage to start small. Chapter 2. The Compound Effect. Your greatest financial superpower. How can small efforts create exponential growth? What if the greatest secret to building wealth wasn't what you earned, but what you allowed time to grow? At 22, Michael and Rachel both graduated college and started their first jobs. Michael, eager to enjoy his newfound income, spent his money on gadgets, trips, and weekends out. Rachel, on the other hand, chose to invest $100 a month in a low-cost index fund, earning an average annual return of 8%. For the first 5 years, Michael's lifestyle looked far more glamorous than Rachel's. He drove the newest car, posted enviable vacation pictures, and ate at trendy restaurants. Rachel, however, stayed the course, consistently setting aside her small investments. 20 years later, Rachel's quiet consistency paid off. Her $100 monthly investment had grown to over $60,000. Meanwhile, Michael, now trying to catch up, realized he'd missed out on years of compounding growth. The difference? Rachel harnessed the compound effect early, while Michael waited until it felt convenient to start. Compounding is the simple yet profound process of earning returns on your investments, and then earning returns on those returns. Over time, this leads to exponential growth. Imagine you invest $1,000 with a 10% annual return. After 1 year, your investment grows to $1,100. By the second year, your total becomes $1,210, not because you added money, but because your returns are compounding. In 30 years, without adding another dollar, your $1,000 will grow to nearly $17,500. The beauty of compounding lies in its exponential nature. It starts slow, but over time the growth becomes extraordinary. In the early years of compounding, growth feels sluggish. This is where many people lose patience and abandon their investments. Let's break it down. In the first 10 years, your $1,000 might grow to $2,000. By the second decade, it doubles again to $4,000. By the third, it leaps to $8,000 and keeps doubling with increasing speed. The longer you let your money compound, the steeper the growth curve becomes. The biggest mistake most people make is delaying their start. Here's an example. If you invest $100 monthly starting at age 25, with an 8% return, you'll have over $300,000 by age 65. If you wait until 35 to start, your total will be just $132,000, less than half. Every year you wait doesn't just cost you time, it costs you exponential growth. The psychology behind inaction. If the math is so simple, why don't more people take advantage of compounding? 1. Short-term thinking. In a world of instant gratification, waiting decades for results feels frustrating. 2. Underestimating the impact. People think starting small doesn't matter, but every dollar invested today multiplies over time. 3. Fear of uncertainty. Many hesitate to invest, worried about market volatility or making mistakes. These mental barriers prevent people from taking the most crucial step, starting. Harnessing the compound effect doesn't require perfection, wealth, or expert knowledge. It requires action. 1. Start small. Even $20 a month compounds over time. The key is consistency. 2. Automate it. Set up an automatic transfer to an investment account to ensure you don't miss a month. 3. Think long-term. Remind yourself that every small contribution is a seed for future growth. So, how can small efforts create exponential growth? The answer lies in the compound effect, a force so powerful that it can turn modest actions today into extraordinary wealth tomorrow. As you continue this journey, remember that every dollar invested is more than money, it's momentum. The earlier you begin, the more time has to amplify your efforts. Are you ready to let time become your greatest ally? Chapter 3: Building Wealth on a Budget. Is it possible to invest when you're just scraping by? Can you truly build wealth when you feel like there's nothing left to save at the end of the month? In her early 30s, Karen was a single mother juggling 2 jobs just to keep the lights on. At the end of each month, her bank account hovered near zero, and the idea of saving, let alone investing, seemed laughable. One day, a friend introduced her to the concept of hidden money. Intrigued, Karen started tracking every dollar she spent. She discovered she was spending over $100 a month on takeout coffee and snacks she didn't even remember buying. Inspired, she redirected that $100 into a high-yield savings account, and eventually, an investment fund. Years later, Karen's consistent small contributions became the seed for a financial cushion that allowed her to quit one of her jobs, spend more time with her kids, and even plan for retirement. The lesson? Building wealth on a tight budget isn't about earning more. It's about seeing your money differently and taking small, intentional steps. For many people, the word budget feels restrictive. It conjures images of deprivation and endless spreadsheets. But a budget isn't about saying no to life, it's about saying yes to your future. The truth is, most of us have invisible money slipping through our fingers every day. Whether it's an unused subscription, impulse purchases, or forgotten fees, these small leaks can be plugged to create powerful opportunities for investing. Karen's story highlights a practical strategy, uncovering hidden money. Here's how you can do the same. 1. Track every dollar. Use a budgeting app or even a notebook to record every expense for a month. Patterns will emerge that reveal where your money is disappearing. 2. Identify low-hanging fruit. Look for easy cuts, like unused memberships or dining out less frequently. 3. Start small. Even $20 a month is a start. The goal is to build a habit, not perfection. The power of automation. Once you've identified your hidden money, the next step is to put it to work automatically. Set up an automatic transfer from your checking account to a savings or investment account. Automating your contributions removes the temptation to spend that money elsewhere. Even if you start with $10 a week, the consistency of automation is what matters. Overcoming psychological barriers. Many people on tight budgets feel stuck because of fear or self-doubt. Common mental hurdles include: 1. It's not enough to matter. People underestimate the power of small amounts. But $50 a month at an 8% return grows to nearly $75,000 in 30 years. 2. I'll start later when I have more. Waiting costs you time, the most valuable ingredient for compounding. 3. I can't afford it. This belief often stems from not truly knowing where your money goes. The key is to challenge these thoughts and take action, no matter how small the steps feel. Building wealth on a budget sometimes requires thinking outside the box. Here are a few strategies. 1. Round up apps. Use apps that round up your purchases to the nearest dollar and invest the spare change. 2. Cashback rewards. Redirect cashback earnings from credit cards or apps into an investment account. 3. Sell unused items. Declutter your home and use the proceeds to kickstart your savings. 4. Use windfalls wisely. Redirect bonuses, tax refunds, or unexpected money toward your financial goals instead of splurging. Karen often felt like her progress was too slow to matter. But she learned to focus on her wins rather than what she couldn't control. Here's how you can do the same. 1. Celebrate progress. Every milestone, no matter how small, is a victory. 2. Find support. Join communities or follow influencers who promote budgeting and investing tips. 3. Stay inspired. Keep reminding yourself of your why, the vision of the life you're building. So, can you truly build wealth when you're scraping by? Absolutely. It doesn't matter where you start. It matters that you start. The key isn't a big paycheck or a financial windfall, it's learning to see your money differently and taking consistent, intentional steps. The strategies in this chapter show that even on the tightest budget, there is a path to wealth. As you move forward, remember Karen's story. The journey begins with uncovering hidden money, challenging your assumptions, and committing to small but meaningful actions. What's your first step? Chapter 4. Mastering the Psychology of Consistency. What stops us from staying the course? Why is it so hard to stay consistent, even when we know that small actions lead to big results? Carlos started strong. At 28, he committed to investing $200 monthly into a diversified portfolio. For the first year, he was consistent, watching his balance slowly grow. Then life happened: a car repair, a medical bill, and an unexpected job loss. Each disruption felt like a valid reason to pause his investments, and over time, Carlos stopped altogether. Years later, Carlos looked back with regret. If he had continued his $200 contributions, he would have had over $150,000 by age 50. Instead, he was starting from scratch. His story is not unique. Consistency, while simple in theory, is one of the hardest habits to maintain. But why? Consistency is a mental game. These are the most common barriers that disrupt our progress. 1. Impatience. Humans are wired to seek immediate rewards. Waiting years to see compounding results feels counterintuitive. 2. Fear of failure. Market dips or unexpected financial hurdles often trigger fear, causing many to abandon their plans. 3. Perfectionism. Believing you must do it perfectly or not at all can lead to procrastination or quitting. 4. Overwhelm. Life's competing priorities make it easy to deprioritize financial goals. Understanding these barriers is the first step to overcoming them. Research shows that consistency thrives on habits, not motivation. Motivation is fleeting, habits are enduring. Here's how to create habits that stick. 1. Start small. Focus on actions so tiny they're impossible to fail, like investing $5 weekly or reviewing your budget for 5 minutes a day. 2. Anchor to existing habits. Tie new habits to existing ones. For example, every time you have coffee, review your finances. 3. Reward yourself. Celebrate small milestones to keep the habit enjoyable and sustainable. Consistency isn't about perfection, it's about persistence. Missing 1 month doesn't erase your progress. What matters is getting back on track. Carlos realized this too late, but you don't have to. Think of consistency like brushing your teeth. You don't skip it just because you missed a day. Your financial habits deserve the same resilience. When life throws challenges your way, how can you maintain your commitment to consistency? 1. Remember your why. Visualize your end goal: financial independence, a secure retirement, or generational wealth. 2. Automate to remove emotion. Setting up automated investments removes the temptation to pause. 3. Focus on progress, not perfection. Celebrate the months you stick to your plan instead of dwelling on setbacks. Consistency is easier when you don't do it alone. Surrounding yourself with like-minded individuals can provide encouragement and accountability. Consider joining online forums, attending financial workshops, or sharing your goals with a trusted friend. For example, Carlos later joined an investing group that kept him motivated and helped him rebuild his habits. Your environment plays a key role in maintaining consistency. Small changes can reinforce your habits. Visual reminders. Keep a vision board of your financial goals or set alerts to remind you to invest. Remove temptations. Limit impulsive spending by unsubscribing from promotional emails. Celebrate milestones. Mark your progress with rewards, like treating yourself after reaching a savings milestone. What stops us from staying consistent? Often it's not a lack of resources or knowledge, it's our mindset. To overcome these barriers, we must shift our perspective. Consistency isn't about being perfect or never failing. It's about showing up, making small efforts, and trusting the process. The most successful investors aren't those who always win, they're the ones who keep going. Are you ready to master the psychology of consistency and unlock your financial potential? Chapter 5. The Portfolio of Small Wins. How do you build an investing strategy that's simple, sustainable, and aligned with your financial goals? When Mia first decided to invest, she felt paralyzed by choices. Should she buy individual stocks? Dive into cryptocurrencies? Experiment with real estate crowdfunding? She spent months researching but ended up doing nothing because the process felt overwhelming. Meanwhile, her colleague James took a different approach. He chose a simple, automated strategy, contributing monthly to a diversified portfolio of low-cost index funds. James wasn't chasing trends or trying to time the market, he was simply consistent. Years later, Mia was still searching for the perfect investment. while James had quietly built a six-figure portfolio. The difference? James embraced the power of simplicity and consistency. Complex investing strategies might seem exciting, but they're often unnecessary and prone to mistakes. Simplicity is not only easier to maintain, it's also proven to yield strong results over time. Here's why simple strategies work. 1. Lower costs. Complex investments often come with higher fees that eat into your returns. 2. Reduce stress. A straightforward plan eliminates decision fatigue and emotional reactions to market swings. 3. Time efficiency. You can spend less time managing investments and more time focusing on other goals. The core components of a simple portfolio. 1. Diversification. Spread your investments across different asset classes, stocks, bonds, to minimize risk. 2. Low-cost index funds. These funds track the market's performance with minimal fees and proven long-term growth potential. 3. Consistent contributions. Regularly adding to your portfolio, regardless of market conditions, is the key to leveraging the compound effect. Here's a step-by-step guide to building a simple and effective investing strategy. 1. Define your goals. What are you investing for? Retirement, buying a home, or financial independence? Clarity will guide your decisions. 2. Understand your risk tolerance. Younger investors can often take more risks, while older investors may prefer stability. 3. Start small. You don't need a large sum to begin. Many platforms allow you to start with as little as $10. 4. Automate your contributions. Set up monthly transfers to your investment account to ensure consistency. For example, a basic portfolio might look like this: 60% in a total stock market index fund, for broad exposure to U.S. companies, 20% in an international index fund, to capture global market growth, 20% in a bond index fund, to add stability and reduce volatility. The danger of trying to time the market. One of the biggest mistakes new investors make is trying to predict market highs and lows. Studies show that even professional investors rarely succeed at market timing. Instead, focus on time in the market, not timing the market. A strategy like dollar-cost averaging, investing a fixed amount at regular intervals, helps smooth out volatility and keeps you focused on the long term. When markets dip, it's tempting to panic and pull your money out. But staying invested during downturns is crucial for long-term success. Remember, the market has always recovered from past declines, rewarding those who stay the course. James's success was largely due to his ability to ignore short-term noise and trust his strategy. You can do the same by focusing on your goals rather than daily market fluctuations. As your portfolio grows, reinvesting dividends and gains accelerates your wealth building. Instead of cashing out small returns, let them compound over time. For example, a $1,000 dividend reinvested annually at an 8% return grows to over $10,000 in 30 years. Keeping it simple in the face of complexity. The financial industry often promotes complex products and strategies to attract attention. But the truth is, the most successful investors stick to the basics. Spend less than you earn. Invest the difference consistently. Let time and compounding do the heavy lifting. What does a simple, consistent investing strategy look like? It's one that prioritizes clarity, automation, and long-term thinking over chasing trends or perfect timing. The beauty of the portfolio of small wins is that it doesn't require perfection, wealth, or specialized knowledge, just commitment. As you build your strategy, remember James's lesson: simplicity, consistency, and patience are your greatest allies. Are you ready to start creating your portfolio of small wins? Chapter 6. The Ripple Effect of Small Wins. Could the simple act of consistent investing create positive ripple effects that transform more than just your finances? When Jasmine started investing in her late 20s, she had modest goals: build a safety net and save for retirement. But over time, something unexpected happened. Her growing financial confidence began to influence other areas of her life. With each small win, hitting a savings milestone, watching her portfolio grow, or sticking to her budget, Jasmine felt a newfound sense of control. She started setting goals in her career, improving her health, and deepening her relationships. By her late 30s, Jasmine had not only built a solid financial foundation but also a more fulfilling, purpose-driven life. Jasmine's story illustrates a powerful truth: small, consistent actions in one area of your life often create ripples that positively impact everything else. Your financial habits shape your mindset, and vice versa. When you commit to consistency in investing, you develop qualities like discipline, patience, and resilience, traits that carry over into other aspects of life. For example, 1. Discipline. Sticking to an investment plan trains you to resist impulsive decisions, whether it's overspending or reacting emotionally to challenges. 2. Patience. Watching your investments grow teaches you the value of delayed gratification, a skill that enhances decision-making. 3. Resilience. Overcoming financial setbacks builds confidence that you can handle adversity in any area of life. Consistent investing reduces financial stress, creating a ripple effect on your mental and emotional well-being. When you know your money is working for you, you feel more confident. Financial security breeds self-assurance. Less anxious. A growing portfolio acts as a buffer against life's uncertainties. More optimistic. Watching small wins accumulate fosters hope for the future. These benefits extend beyond your finances, improving your overall quality of life. Financial stability often translates into greater career confidence. When you're not living paycheck to paycheck, you can 1. Take risks. Pursue opportunities like starting a business or changing careers without fear of financial ruin. 2. Negotiate better. Secure higher salaries or benefits because you're not desperate for any job. 3. Invest in growth. Use your resources to acquire new skills or certifications that enhance your career prospects. Financial stress is a leading cause of tension in relationships. By mastering your finances, you create space for healthier connections, shared goals. Investing with a partner fosters collaboration and alignment on future dreams. Reduced conflict. Financial stability eliminates many common sources of stress, like debt or unpaid bills. Generosity. With growing wealth, you're better able to support loved ones or contribute to causes that matter. Consistent investing doesn't just transform your finances, it unlocks the door to pursuing personal goals far beyond money. 1. Health. Financial stability empowers you to invest in self-care, from nourishing meals and fitness memberships to stress-relieving activities that improve your well-being. 2. Time freedom. As your portfolio grows, so does your ability to work less, explore the world, or immerse yourself in hobbies you're passionate about. 3. Legacy planning. With increased financial confidence, you'll naturally begin envisioning how to create a lasting impact, building a legacy that benefits future generations. Just as compounding grows your investments, it also amplifies your personal development. Consider how small, consistent actions like saving, exercising, or learning build momentum over time. A single investment grows into a retirement fund. A daily walk becomes a healthy lifestyle. A new skill leads to a promotion. The principle is the same. Small actions create big outcomes when applied consistently. Examples. 1. Daniel's career leap. Daniel started investing at 24. By 32, his financial stability allowed him to quit his corporate job and pursue a passion for photography. 2. Maria's family impact. Maria introduced her kids to investing, teaching them the value of consistency. Today, they're financially literate young adults with growing portfolios. 3. Andrew's health transformation. With less financial stress, Andrew had the energy and focus to lose 50 pounds and complete his first marathon. These stories show how small financial wins can create a domino effect that transforms lives. How to amplify the ripple effect. To maximize the impact of your financial consistency. 1. Set holistic goals. Think beyond money. Align your investments with broader life objectives like freedom, family, or personal growth. 2. Celebrate progress. Reflect on how far you've come, not just financially but emotionally and mentally. 3. Pay it forward. Share your knowledge and habits with others, creating ripples that benefit your community. How does consistency in investing impact your whole life? The answer lies in the ripple effect. Small wins in your finances build confidence, reduce stress, and empower you to create positive change in every area of your life. As you reflect on your journey, consider this: what ripples could you create by committing to consistent, intentional actions today? Chapter 7. Staying the course during tough times. When life throws challenges your way, unexpected bills, job loss, or a market crash, how do you stay consistent with your financial goals? In 2008, during the global financial crisis, Trevor faced the ultimate test. He had been investing steadily for years, but when the market tanked, his portfolio lost nearly 40% of its value. Fear crept in, and he considered pulling all his money out. However, Trevor's mentor reminded him of a simple truth. The market rewards patience, not panic. This is part of the journey. Reluctantly, Trevor stayed invested and continued his regular contributions, even as it felt counterintuitive. Fast forward to 2020, and Trevor's portfolio had not only recovered but nearly tripled in value. Staying the course during tough times had been the most profitable decision of his life. Financial disruptions come in many forms: job loss, medical expenses, market volatility, or even personal emergencies. While these challenges can feel overwhelming, they don't have to derail your financial journey. The key to resilience is preparation, perspective, and persistence. Prepare for tough times. 1. Build an emergency fund. Before focusing on long-term investments, set aside 3 to 6 months' worth of expenses in a high-yield savings account. This safety net prevents you from dipping into your investments during crises. 2. Diversify your income. Consider multiple income streams, like freelance work or a side hustle, to reduce dependency on a single paycheck. 3. Revisit your budget. During tough times, look for areas to cut back temporarily. Small adjustments can free up funds to keep your financial goals on track. When tough times hit, emotions often take over. Fear, frustration, and even shame can cloud judgment and lead to rash decisions. Here's how to manage those feelings. 1. Recognize emotional triggers. Acknowledge the anxiety you feel during financial challenges. Awareness helps you avoid reacting impulsively. 2. Stick to your plan. Remind yourself why you started. Returning to your goals can provide clarity and motivation. 3. Seek support. Talk to a financial advisor, trusted friend, or mentor who can offer perspective and guidance. Market volatility is one of the most common challenges for investors. The instinct to sell during a crash can be overwhelming, but history shows that markets recover over time. Consider this. If you invested $10,000 in the S&P 500 in 2008 and left it untouched, it would be worth over $30,000 by 2020. Selling during the downturn locks in losses, while staying invested allows you to benefit from the eventual rebound. Strategies to stay the course. 1. Focus on the long term. Market dips are temporary, compounding is permanent. 2. Automate contributions. Keep investing automatically, even during downturns, to buy shares at lower prices. 3. Avoid checking too often. Constantly monitoring your portfolio during volatile periods can heighten anxiety, turning setbacks into opportunities. Tough times can also present unique opportunities. Market crashes equals discounted assets. A market downturn allows you to buy high-quality investments at a discount. Use setbacks as a chance to reflect and refine your financial priorities. Learn and grow. Challenges build resilience and teach valuable lessons about discipline and patience. Examples of resilience. 1. Nina's job loss. After being laid off during the pandemic, Nina used her emergency fund to cover expenses while starting a freelance business. Today, she's earning more and saving aggressively. 2. James's market panic. James stayed invested through a market crash and took advantage of lower prices to buy additional shares. His portfolio doubled within 5 years. 3. Lila's medical bills. Lila faced unexpected medical expenses but avoided selling her investments by tightening her budget and negotiating payment plans. Resilience during tough times isn't just about surviving, it's about thriving despite challenges. Here's how to maintain a positive outlook. Gratitude practice. Focus on what's going well, even in difficult periods. Visualize the future. Picture the long-term rewards of staying consistent. Celebrate small wins. Each step forward, no matter how small, is progress. What happens when life disrupts your plans? Challenges test your commitment, but they also offer the greatest opportunities for growth and resilience. Staying the course during tough times isn't easy, but it's what separates successful investors from the rest. The key is to prepare, persist, and keep your eyes on the long game. As you navigate your own journey, remember Trevor's story: patience pays off. Will you trust the process and let your small wins carry you through life's toughest moments? Chapter 8. Your Legacy of Wealth. What if the small financial choices you make today could empower not only your future but also shape the lives of generations to come? When Anthony was a young man, he watched his parents struggle with money. They worked hard, but their paycheck-to-paycheck lifestyle left little room for savings or dreams of a better future. Determined to break the cycle, Anthony started investing $50 a month in his 20s. Over the years, that $50 grew into a substantial nest egg. But Anthony's real breakthrough came when he decided to teach his children about money. He showed them how to save, invest, and understand the power of compounding. By the time his kids graduated high school, they had small investment accounts of their own. Today, Anthony isn't just financially secure, he's created a family culture of wealth building and financial literacy. His children are thriving, and his grandchildren will benefit from his legacy. A legacy of wealth isn't just about money, it's about creating opportunities, security, and knowledge for future generations. It's a ripple effect that starts with small, intentional actions. Building a legacy involves three core components. 1. Financial security. Creating a foundation that allows your loved ones to thrive without financial stress. 2. Generational wealth. Passing down assets like investments, real estate, or businesses. 3. Financial literacy. Teaching the next generation how to manage and grow wealth responsibly. Generational wealth provides stability and opportunity. Families with financial resources can pay for higher education, reducing the burden of student loans, support entrepreneurial ventures or creative pursuits, provide a safety net during life's uncertainties. But wealth alone isn't enough. Without financial literacy, even the largest inheritances can be squandered. Teaching financial literacy to the next generation. Your legacy begins with education. Here's how to teach your family about money. 1. Start early. Introduce basic concepts like saving and budgeting to children. 2. Model good habits. Show by example how to spend wisely, invest consistently, and avoid debt. 3. Encourage ownership. Help teens open their own savings or investment accounts to learn by doing. 4. Discuss money openly. Create a family culture where financial topics aren't taboo but opportunities for learning. Passing down wealth requires careful planning to ensure it endures. Steps to consider. 1. Create a will or trust. Clearly outline how your assets will be distributed to avoid confusion or disputes. 2. Name beneficiaries. Ensure your investment accounts, life insurance, and retirement plans have up-to-date beneficiary designations. 3. Set up a financial plan. Work with a financial advisor to maximize your estate's growth and minimize taxes. A legacy of wealth isn't just about your family, it's also about the community. Charitable giving allows you to extend your impact even further. 1. Philanthropy. Create scholarships, fund community programs, or support causes that align with your values. 2. Teach generosity. Show your children how to give, whether through time, money, or resources. These actions create a lasting legacy that goes beyond financial success, embodying the values you hold dear. Real-life legacies. 1. The Jones family. By teaching their children about investing, the Joneses turned a modest inheritance into multi-generational wealth. 2. Maria's Scholarship Fund. After achieving financial independence, Maria created a scholarship program for underprivileged students, transforming countless lives. 3. Alan's Trust Fund. Alan set up a family trust that ensures his grandchildren will have financial resources for education and entrepreneurship. These stories show how small wins today can lead to extraordinary legacies tomorrow. Aligning your legacy with your values. A meaningful legacy reflects your personal values and priorities. Here's how to align your wealth building with what matters most. Define your vision. What do you want your legacy to achieve? Focus on impact. Identify specific ways your wealth can create opportunities for others. Write it down. Document your goals and share them with your loved ones to ensure your vision is clear. Just as compounding grows investments, it also amplifies the impact of a legacy. Each lesson you teach, dollar you invest, or opportunity you create becomes a seed for future growth. Consider this. The $10,000 you leave to your child today could grow to $100,000 in 30 years if invested wisely. Teaching a child about compounding could empower them to grow that wealth even further. How can small wins today transform generations tomorrow? The answer lies in the choices you make right now, the investments, the lessons, and the values you pass on. Your legacy isn't just about money, it's about empowering others to dream bigger, achieve more, and create lasting change. The ripple effect of your small wins has the potential to transform not just your life, but the lives of countless others. So what steps will you take today to ensure your legacy of wealth is one of purpose, possibility, and prosperity? Take care and be well.